All right. Good morning, everybody. We're waiting on something. I don't know what it is, but we're waiting on something. Market started to coil yesterday afternoon. This is like a coiled spring. If you look through the economic data for the US, we don't have anything until later in the week. And while the things we have coming later in the week are kind of big, they're not really big. We got GDP and job numbers tomorrow, 4 PCE on Friday, and that could be something, but this is too early for that. So, uh, don't know, right? It's concerning because the markets are worried about something, so we need to be worried about something. And one of the things that I've always tried to press is that we don't always understand or know what is freaking out the market. And that's just the way it is. We don't always need to know. The main takeaway is that you're able to spot it, that you can recognize that something is different, something is off, and there's enough warnings there to let you know, reduce position size, close trades that maybe are a swing in profit or slightly profitable, or maybe they haven't really started to move in your direction yet. Just reduce risk and prepare for big moves. And it doesn't have to be a big move down, to be fair, right? I know that's the easiest takeaway, is to think, oh, well, we're going to sell off and it's going to be horrible. Yeah, maybe. But that's a coin toss of 50-50 at this point. We could just as easily spike to the upside as we could drop to the downside. Hong Kong, Japan, both basically flat with the NASDAQ and the S&P and the small caps and the Dow. The UK is near 0.25%. Otherwise, we got Euro stocks down more than 0.5%. And we are a market waiting on something. We could always speculate on what that something is, but hopefully you get the idea that at the end of the day, it really doesn't matter what it is. It'd be nice to know, right? I'd always rather know than just, go through the day in ignorance. But if you can't, then you can't. So keep your eye on the news today. Keep your eye on price. We're looking for this coil to end, and that's how we'll know we're done with the event. And whatever that event happens to be, there has been periods in history where we didn't have an event and we didn't have a narrative. They put one together after something happened. Doesn't really feel like it's going to be that way today, but it doesn't even have to be today. We've seen big events in history come that have stalled the market 2 days before, like one of NVIDIA's historic earnings like 18 months ago or something like that. That one was so big that we went sideways for 2.5, 3 days before we finally had the earnings on it. So it doesn't have to be today. Whatever it is, it could be tomorrow. Maybe it is the GDP. We just don't know, and it just doesn't matter at the end of the day. We got some Fed speakers today. We do have data coming out of Japan tonight. And we're going to get ECB speakers later in the morning, I believe, as well. This got my attention earlier today. Chancellor Reeves' economic statement coming later today. Analysts expect her to cut government spending by billions of pounds. I don't think that's going to be it, right? But again, just want to keep your eye on the headlines and watch the clock. one of the good things about watching the clock, or the good thing about these events and economic calendar, is that they're almost always on the half hour or on the new hour. So even if we don't know what the event is, it's very likely going to be happening in line with the clock. Footwall 5650. We're above the 10 and the 20 day. The 10 is not yet above the 20, so we don't have that signal, but price is above both and holding, stuck underneath the 0 gamma line and not yet to the 10 week. But the 10 week continues to move to the downside while we are continuing to move to the upside. Call wall 5900, big round number, can't miss it. We started coiling yesterday afternoon. And we're still in it. So it's a relatively tight range. GTFO, we got to get out of the box. Got the 111 and the 1236 above and below. We've been dancing through the halfback, so it doesn't have any value at this point. Whatever it is that's going to trigger this move, it's likely to cause something like an economic candle, a liquidity candle, a liquidity gap. So if or when we start to get a big push, pivots will break. Pivots don't stop economic candles, economic events. It'll drive right through anything like that. It'll be after that. You see how narrow today's range is compared to our ADR lines. Even the smaller ADR, these two red lines, they're both outside of yesterday's range. So ADR, for those that are unfamiliar with the concept, is average daily range. I set mine to 21 days and I use a simple average, no weighting against it or anything like that. And we're just looking back over the last month, asking what was the average daily move from top to bottom over the last month? What's our average movement? Because it's what stocks do, right? It's what price does. It doesn't just drive in a single direction. Even if we close higher on the day, a lot of times we still go down and we go up, right? So it's a wave. We go in both directions. So the average daily range right now is 1.87%. It's about 110 points on the ES. Well, from 6 o'clock last night, if we split 110, then it's 55 to the downside, 55 to the upside, and that range between the two red lines is 110. But what if we opened at 6 o'clock last night and we ran in a single direction for the entire average daily range? If we didn't have that wave where we went up and down. The yellow line is 110 points from where we opened at 6 o'clock last night. It's the average daily range. Same thing to the downside. So we've got the range if we move in both directions, like price generally does. And we have the range if price just picks a single direction and runs the entire day in that direction. Now the day is half done and we haven't done anything. So if we're going to go to one of those lines, we would be doing it on a shorter time span. We can still do it. We would just have an increased rate of change. Since we're flat at the moment, there's no edge on us going to either one of these red lines or to the yellow lines. We have to get out of this box and we have to know why or what price is waiting on. When we think about bouncing off a support and running up into resistance, whether it's a dead cat bounce or just your typical bounce and run into resistance, the resistance that we have overhead is this halfback line, 5,900. But we've also got a 200 period moving average, and that's a real common marker or a resistance level. We bounce and run into the 200 from below. If this was stocks and not the ES, that would have been one of the first things I would have focused on for a target to the upside on the bounce. And we can see this purple line here, 5909 is my 200-day moving average. It's also the halfback. So it's the same thing, whether I got it from a measurement or I got it from a moving average. It's one good thing about technical analysis is when you get the same answer from multiple sources, got a stronger conviction in the answer. We talked about this distance from the weekly pivot yesterday. And while I don't think this is as extreme as we've seen it in the past, it is a considerable distance. It's around 2%. I think we could get at least 2.5, maybe even closer to 3. But if we test yesterday's high, try to go higher, and we fail again, it's very likely that's it. We will have topped out on our distance from that weekly pivot, and we'll stall against these highs or we'll fall from those highs. There is a really good phrase, though, in technical analysis, is that crashes don't come from the highs, right? We crash from the lows, from oversold conditions, not from overbought conditions. We don't crash from bounces to the upside like a dead cat bounce that we've had. And to be fair, this is not a rally, right? This has been nothing more than a bounce all along. We had an MDP yesterday, a missed daily pivot, a pivot that we did not hit. That counts for today, not yesterday. But we had 2 in a row. The pivot today, we've already hit it. Today's pivot opened higher than yesterday. That's bullish. Price opened above the pivot. That's also bullish. And we've come down and we've interacted with that pivot, which means we are no longer owed a move to the downside. The channel, it's not as wide as yesterday, but it's still relatively wide, all things considered. A wider channel implies that if we break out, we don't go anywhere, it doesn't stick, and we come back in again. If we are in a coiled spring and we're not going anywhere and we're waiting on something, when it comes, it's not going to matter if this channel was narrow or wide. Whatever the data is, whatever the event is that drives us and gets us out of here, it's going to rule, and pivot points won't matter. $58.11 cog line, this week's point of control. You can see the distribution that we've been putting in. It's as wide as the value area high and value area low, 30-point range, relatively tight. That's where 70% of all of the volume is for this week. And if we zoom out, we can see that's the channel that I drew for the first week of March, and that high volume node around its point of control. Those point of controls are almost perfectly lined up. Just call it 5,800 if you want. I like the cog line 58.11, but that needs to hold, or I think we're going to revisit and get this gap closed and then get into 5,700 and on down from there. It's hard not to instinctively want to look at all of this as a bearish setup and a bearish bias. But I want to argue as much as possible that at this point, it's not bearish. It's not bearish. It's not bullish. It's cautionary. It looks like one more day we'll have the point of control moved. We're on a 10-day, 30-minute chart. We can see that TPO is not reflecting with the volume, but it's likely we're going to see the point of control move on the volume side up to the 58.20 area. We're putting in a lot of footprints up here. It should be by the end of the day today, maybe tomorrow. I say maybe tomorrow because the S&P had record low volume yesterday at the end of the day. And we've had some low volume days, so it stands out because it's a record. But on the other hand, it doesn't stand out that bad because we've been getting a lot of low volume days. No VPOC for today. We've already come down and hit the point of control of yesterday. We've crossed through it. Now, the textbooks will tell you to mark it anyways, right? I'm a little particular. I've got enough pivots. I don't need to add more just to add more. So I don't carry forward the point of control from the previous day unless it's a VPOC. But the textbooks will tell you to carry it forward, right? The value area low, the value area high, and the point of control from the previous day, they have value, they have merit, and it's worth knowing where they're at. With today and us hitting it and really not staying down there and digesting that, we could consider that an area of unfinished business. And if we go back down there again, it's likely that we'll see price respond at that level. We don't really want to consider it as a support level. And if it was over our head, we wouldn't want to consider it as a resistance level. More of an area of interest, an area of unfinished business. It's where the greatest amount of trading took place yesterday, or the greatest amount of volume took place yesterday. And with no bias whatsoever, we can say if that's where the greatest amount of trading took place yesterday, we could see trading at that spot again today in size if we happen to go back and revisit it. That doesn't require us to be bullish or bearish or consider it as support or resistance, and it doesn't add any bias to it. It's just an area of concern. We do have a little discrepancy this morning between the TPO and the volume profile. But I don't think it's enough to warrant any extra attention. We're still messing with the edges of the weekly expected move. This is how far we were supposed to move for the whole week. We got there in a single day. Generally speaking, we should close inside this range 80% of the time. Now, we haven't done that a lot lately. We've been breaking outside the range, closing outside the range more than we should, which doesn't tell us that the indicator is broken or that our approach to using the indicator is wrong. It tells us that price is exceeding what is being priced into the market, right? This volatility is priced in, and yet we see daily moves that are well beyond what is priced into the market. So they can tell you the VIX is down, and that implies the volatility is low, but price movement is volatility. Volatility is a nerd word for movement. So they can say volatility is down all they want. When we move an entire week's range in a single day, volatility is still high because we are still getting big moves. Moves that exceed our expectations of movement. 1% above the 10-day, we're still in the sweet spot. We're outside of the gravity zone, and we're above the 10, which puts us in a bullish bias. From a swing trade perspective, maintaining above the 10 is healthy. It's good. It's a signal of momentum and surge. One signal you can use with this is if price drops below the 10 and then takes the 3 or 4 period moving average below the 10. That would be a negative surge signal. We don't have anything like that because, well, price is above the 10 for now. Looking at the 10-week, we're still below it. We're just coming back up to meet it. The concern is that we'll do something like we did back here in 2002 in that bear market, where we dropped significantly below the 10-week. We came all the way back up to it, didn't quite interact with it, and then down we went again in an even deeper and steeper drop away from the 10. That's the concern. So we want to get above it, establish a base above it, put in some work, and then continue to expand on the upside beyond the 10. But first we have to get there. If we go back and look at the 10, there's your 10-week. I know this is a 15-minute chart, but it's still the 10-week. 58.70, basically, if you want to round it up a little bit. We got to get above that 10-week. GameStop is up significantly this morning because it's voted to buy a bunch of Bitcoin. Generally, GameStop is a tell for hedge fund factor rotation or short covering rallies, things like that. But we're going to have to find a new toy or a new vehicle because now that they've voted to start buying Bitcoin, it's not going to be our proxy play anymore. Still got a bit of a problem when it comes to money moving around. And I came across some information in money flows. It really got my attention. See if I can get it brought over here. There we go. This was posted by Bar Charts. Foreign investor ownership share of U.S. equity market sitting at all-time highs. Now, I don't know if you guys have, didn't get the message, but for the last month, all we've heard is money leaving in the U.S. at record numbers, right? The outflows from the U.S. has been significant and record-breaking, and money is leaving the U.S., blah, 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 again and again. At the same time that we've got foreign investor ownership at record highs. So I don't know. I threw that out there. I think it's worth considering the idea that if both of those statements are true, then it's U.S. money that's leaving U.S. markets and going to foreign markets. It's not money going home, which was the original consensus, right? Europeans trading in the U.S. markets went back to Europe, or Chinese money trading in U.S. markets went back to China. That was the prevailing wisdom. That post kind of disabuses that notion. If we're looking at a factor rotation or even just a sector rotation, which the top three up here risk on versus the bottom three down here risk off. The difference between these two aren't that much. We were both moving in the same direction. Now the difference is negligible, other than the fact they're going completely opposite directions. They were both bullish, they were both bearish, then they were both bullish. Now we've got one bullish, one bearish. So if we're going to look for that rotation to spread out and see a wider change in the growth versus value, then we want more of this. So we want these defensive sectors to continue to stay weak. They don't have to fall significantly. They just need to not rally significantly, while we continue to see more positive moves in the top three. So that when you look at something like growth versus value, that is pointed to the upside like this. This is a growth versus value. Growth is outperforming when it's pointed up. Value is outperforming when it's pointing down. Looking at what's up this morning, agriculture is up the most, then the VIX, crude, airlines, China, energy, gold, silver, gold miners, and that's it. That's where it stops out. Speaking of the VIX, Spot Gamma's AM edition had come out right before I started. I didn't really get a chance to read through too much of it. So keep your eye on the VIX. This will be a bit of a tell. We had swag levels that we were using the other day, right? 19, or I like 20, but 19 is popular. See how we stabilized around 17. Breaking 17 and getting another leg lower would be bullish for the markets. I think they'd really respond to that to the upside. On the other way around, 19 is the bare minimum, right? Or that 10-week moving average, which is close to $19. If we get the VIX above its 10-week moving average at this point, that would be concerning. We're below the 10 and the 20-day, but we're also below the 10-week on that breakdown Monday. So we need to get back above that to really start to spook U.S. markets and perhaps see a change in this range that we're in. So if we do break down today, but the VIX really doesn't get excited, I'd look for that breakdown to be a fake breakdown without a lot of follow through to it. But if we start to break down in the markets and the VIX gets through this 10-week, gets through the 19, there's a 3-week moving average there, then keep your eye on the 10 and the 20. Now, bouncing up into the 10, well, it's what the VIX likes to do. So if we do bounce, we get through 19, reject on that 10-period moving average and roll over, then fine, great. That would be the fake sell-off that we're looking for. And the S&P and the NASDAQ would very likely rally back up again after that fake breakdown. We saw some really big moves in the 10-year and matching moves in the ES. This swing here to the upside in the ES, which is the chart on the right. All of that was matched with this move in the 10-year. And this chart all the way on the left, that's the 10-year. What we didn't really see was a significant move in the dollar in either way, right? We've just been holding between this like 3.5 and 4 point area. We don't want to see a significant move in the dollar up or down. We know they need a lower dollar, and this move kind of highlights that, we are lower, but they want more. They kind of need more. But we don't want to see big, significant moves like this. This is not what we want. Up or down, we need the dollar to move calmly and rationally. So if we start to see yields picking up like we're doing this morning, we should expect to see the ES start to pick up with it. They should be hopefully giving us the same kind of pattern that we saw the last time we started to get a big move. A little bit of a tell that we can use right now, right? But at the same time, just keep your eye on the dollar, because if we start getting these moves in the yields that are big like this, and we get big moves in the dollar at the same time, then it starts to be a concern, right? Otherwise, guys, watch the clock. Keep your eye on headline news. This market is coiled up. It's waiting for an excuse or waiting for a reason, and we don't know what it is. So we just have to be vigilant. Be careful. Be